In this video, I want to walk through 4 different examples of using our understanding of relevant costs to make decisions for the company. This first example is what's called a special order. In this scenario, we have a company that manufactures a piece of equipment. They sell it for $32 per unit. They have a capacity of 50,000 units per year. And at that level of production, I've listed out costs: direct materials on a per unit basis and in total, direct labor, variable manufacturing support or overhead, fixed manufacturing, variable selling expenses, fixed selling expenses. And so what we're basically looking at is a total per unit cost of $27, a total cost at the capacity of 50,000 units of $1,350,000. Now, what has happened is that another company has requested a one-time only purchase of 10,000 units. They will pay $4 per unit plus the per unit manufacturing costs, variable and fixed. So essentially, the cost is being determined by how much it cost plus $4. We're anticipating that we'll only sell 40,000 units this year outside of this special order, and we would not incur any variable selling expenses on the special order, which probably means the variable selling expenses or commissions, which we may not have to pay given the fact that the company reached out to us. So here's the analysis. We have a sales price of $40,000. That's the 10,000 special units at $4. Then they're going to reimburse us for those 10,000 units all of the manufacturing costs. That's $21, which consists of the direct materials, the direct labor, the variable, and the fixed manufacturing support. Notice they're not reimbursing us for selling, only manufacturing. So that would be, in addition to the 40,000, an additional 210,000. Total revenues then would be $250,000. Our direct costs would consist of the materials and the labor, which would be the $12 in materials at 10,000 units, $3 in labor at 10,000 units, and then the variable manufacturing support, which would be the $1 at 10,000 units, for total costs of $160,000. Notice that I did not incorporate any fixed manufacturing costs into the analysis. That is because the fixed costs, by definition, are the same as long as we remain within the 50,000 unit capacity. Since we're only planning to sell 40,000 units, an additional 10,000 will keep us within that relevant range of 50,000 units. So fixed costs don't even play into it. They're already being covered by our regular sales. So if you take the 250,000 in revenues, back out the 160,000 in costs, we're looking at operating income of $90,000 strictly on the special order. There's no reason not to take the special order because it will increase our operating income. Now, let's change the scenario just a bit, because in this scenario, we had the capacity to cover the special order without turning away any other customers. Now, let's assume instead that we actually think we can sell 50,000 units this year through regular channels. What that means is, to take this special order, we're going to have to turn away 10,000 units at our regular selling price. So notice what's going to happen. Our sales through regular channel at 10,000 units would have been yielded $320,000. The 10,000 units at our regular selling price of $32. Then revenues under the special order would have only been $250,000, which means we would have actually yielded $70,000 more in revenues if we kept our current customers and did not take the special order. Now, remember that the special order does not need to use any of the variable selling expenses. So we would save $20,000 in variable selling expenses. But that still means our net operating income will decline by $50,000 if we take the special order in a scenario wherein we'd have to turn away our regular customers. Now, there is another thing to consider, and that is what would happen if we turn those customers away and they didn't come back. I mean, it may mean that it's not just a $50,000 loss this year, it would be more down the road. But maybe this is a company that we have been trying to get to buy our product for a lengthy time, and we think we could generate new customers if we take this special order. Point being, there are always qualitative considerations to make when you walk through a scenario like this. The costs are important, but there may be other implications as well. So make sure that you think about those implications too. So the second scenario I want us to walk through is the decision as to whether or not we're going to make something or buy something. We've sort of already walked through something similar to this if you watch the video on relevant versus irrelevant costs. But in this scenario, we're a company that manufactures a part for our own use in production of a final product. So we produce a component that we use in the product we sell to the customers. We can actually purchase 10,000 of these for $6 per unit, in which case we could use the plant facilities for something else and save $9,000 plus $1 of fixed overhead would be eliminated. Our current scenario, here are our manufacturing costs. Direct materials, 60 cents per unit. Direct labor, $3 per unit. Variable manufacturing overhead, $1.20 per unit. Fixed manufacturing overhead, $1.60, for a total of $6.40 per unit. Here's the analysis. If we buy the product, we will spend $60,000, 10,000 units at $6 per unit. We will, however, save that $9,000 because we're going to be able to use it for something else. So that will offset the purchase price. We will also save $1 per unit of fixed overhead. So that too will offset the purchase price, which means in terms of relevant cost to the decision, it will cost us $41,000 to buy. Now, what's relevant to make is what we would give up or what we would save if we chose to buy the product. We will save the direct materials, which is $6,000. We will save the direct labor, which is $30,000. And we will save the $12,000 in variable overhead. Notice the only thing we're saving in fixed overhead is what they tell us, because fixed overhead by definition isn't necessarily tied to what we're producing. So we would actually save $48,000, which means there's a $7,000 benefit here to buying the product from this particular company. Now, again, there are some other considerations. It's not all about cost. That's important, but there are other things. For instance, keeping in mind that this is a component that we use in our final product, is the quality going to be as good? Because if we're not manufacturing it, we don't have control over the quality. So we want to make sure that the component has the same level of quality that ours does, or the quality of our end product may decline, and that will impact not only our sales, but our reputation. The other thing to consider is whether or not the company from which we would buy this product can meet our timing needs. If we're in the middle of a production line and the vendor hasn't delivered what we need, then it may hold up our timing on getting our own product complete. So again, similarly to the previous example, keep in mind we need to consider all aspects of the decision, maybe not just the cost. I am going to end this video now, and I'm going to create a new video that focuses on the last two examples. So you can find the other video on Canvas as well.